Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Interest rates are falling, tariffs are evolving, and the AI market continues to hold steam. Today we're breaking down how those shifts are playing out in portfolios, supply chains, across the consumer landscape, and particularly in smaller names. How does the breadth of Fidelity's research help connect the dots across all of these things that we're speaking about? Happy to say joining us here today to discuss is Director of Research and Portfolio Manager Steve MacMillan and Equity Research Associates Connor MacGrath and Christian Ghezzi. This conversation features live French audio interpretation, so our conversation can be heard in either official language. Welcome to each of you. Thanks for being here today.
Thanks.
And do send your questions in. We'll take those over the course of the next half hour. I'll ask you, Steve, to begin a little bit with the landscape for small and mid caps. As we say, interest rates are down. This should be the opening of the doors. It kind of has been. Tell us where we are.
Thanks. I'm excited to be here to talk about small caps. I'm more excited to listen to these two talk about small caps. I think they'll be very insightful. Small caps have been wandering through the desert for about 7 years now and are just starting to see an oasis. And so we're finally starting to see some outperformance. They're benefiting from the expectation of lower interest rates currently and in the future, which generally benefits smaller companies. They tend to have a bit more debt on their balance sheet, be less equity financed, more debt financed. Some interesting things going on though in the small cap landscape outside of just the broad macro. We have some winners, we have some losers. If you look at the broad indices, you would look at a market off the bottom in early April that has been up very significantly, but within that it's been very uneven. And I think that Christian can talk about some of those winners. Unfortunately, Connor can talk about some of those losers. But
Consumer, more tech AI, okay.
Yeah, it's been a very uneven trade. One of the things that I find fascinating right now is while the broader indices are making new highs and it's by all accounts a bull market, you have these quiet bear markets that are going on underneath in some of these consumer stocks. It's very clear that the lower end consumer is in a recession already. At the same time, if I think back through my 25-year career at the number of different bubbles that I've seen come and go, there's areas that look very bubblish right now that kind of filter down, starting at the high-level AI trade, that come down to some of the areas like quantum computing, come down to areas like power demand for AI, part suppliers for data centers. There's a lot going on under the surface.
There's just money being thrown in those areas, and it looks a little frothy,
Yeah, I
whatever
think
term you want to use.
Yeah, right now I think about NVIDIA and the hyperscalers as being the giants, and then I look at the tech hardware companies that Christian might be looking at as looking for the crumbs of giants, which still can be quite big. So there's a lot of excitement in the market around some of those stocks that are picking up those crumbs.
Okay, fantastic. That's so interesting. Well, let's actually begin with the health of the consumer. Connor, I'll ask you a little bit about this. The tariff story seems to be the theme. I mean, there are other themes to pick up on, but it is how companies have adjusted, and they have adjusted. Why don't you take us there initially, just how companies have marched through this period of time?
Sure. And I think it's emblematic of what we're seeing in the consumer around bifurcation around low income versus high income consumers. We're also seeing that in terms of how companies respond to tariffs, where there are winners and there are clear losers. Companies that have responded better, companies that haven't responded as well. And so, as you mentioned, there's been a lot of volatility. It seems like the tariff policies change every month or every few weeks. And so we obviously had a lot of news thrown at us in April with Liberation Day. But then since then, though, you've had multiple tariff policy changes and whatnot. And so I think collectively, you've seen a broad response by companies to shift their supply chains. Maybe it's within Southeast Asia, maybe away from China into neighboring countries like Vietnam or Indonesia or whatnot. Other companies are maybe trying to onshore certain parts or certain components or things like that back to the US to help mitigate some of those impacts. And across my coverage, Steve and I, we meet with a lot of companies and we see a lot of bifurcation in this in terms of companies that are handling it quite well. There's an appliance company that I cover called Shark Ninja. They've done some interesting things just around shifting their supply chain pretty substantially away from China into other countries, tweaking kind of the components that they have in their products and whatnot to help kind of mitigate some of that tariff impact so that they don't have to pass on as much of the impact to the end consumer.
That's really interesting and innovative, as
Yeah.
you say. Christian, take us to the AI discussion of smaller companies. So we spend a lot of time on 7 big companies, sometimes 9, sometimes a few more biggies. But this is really a discussion of, I guess, the crumbs, as Steve was mentioning. Tell us most recently what you're noticing. Is there themes across this? I mean, it's all systems go.
For sure. I think bifurcation is the name of this episode. So you're seeing, clear eye winners take off. So this would be like the companies Steve just mentioned, like the picks and shovel plays, the ones where, you build a data center and they generate revenue from that today. And then you're also seeing the market bucket pretty aggressively AI losers, or at least perceived losers. And these would be businesses that either aren't directly exposed to this. And so you're kind of having like this hardware build suck the air out of the room for demand for what they sell, or even maybe less obviously, but more kind of aggressively from the market is just this view that if AI is to commoditize a lot of knowledge work and what we do and kind of developing applications, then it should erode the competitive advantages of a lot of software companies I cover. And so you're seeing a lot of those companies be bucketed as losers. And I think part of the research process here is that we can be closer to a lot of these smaller cap companies just because of our breadth of research, and we can understand what actually made these businesses good. In a lot of cases, it's actually not the fact that they had developers that can code a lot, right? These aren't just code factories. Oftentimes, the reason they were able to succeed is because they're close to the customer and they know what the customer wants. And so because of that, they have a very directed R&D motion that gives them the continued right to win customers. So
you mentioned perceived losers,
yes.
which is interesting because do you feel the market can shift around that? That's still at play to an extent?
Absolutely. That's an ongoing debate. Things move fast and they move even faster in tech. And today with AI, you're arguably seeing the fastest pace of adoption we've ever seen for disruptive tech like that. You're actually seeing consumers adopt AI faster than the internet.
Okay.
And
carry on.
So yes, that can change a lot, and there are examples of that changing. So an example, a stock that we looked at here, a database company, MongoDB, they were a perceived AI loser. There was a competitor that appeared to be kind of taking share within new AI use cases, and it was proven that that wasn't actually the case. Numbers were fine, and the kind of narrative went from an AI loser to an AI winner overnight. And so that can happen quickly. And again, that's why it's important to kind of have eyes on these small companies, because there's a big opportunity to generate market outperformance if you can identify a perceived loser going to winner or vice versa.
That's fascinating. Take it back to the consumer just for a second, Connor. A big piece of the story seems to just be inventory as well, which some of it seems to be a COVID hangover, and we're still seeing Rails grappling with that. And so how much of that is the inventory story in the companies that you cover? Some of them did a big pull forward.
Yeah, so there was a big pull forward. You saw that in the earlier parts of the year. And so what you're kind of seeing right now is a lot of the inventory that's been sold, let's say in Q2 or maybe even Q3, is still not the tariffed inventory, kind of quote unquote. Right. And so the end consumer maybe hasn't fully seen a lot of the tariffed inventory start to hit the shelves, let's say in a retailer like a Walmart or something like that, where you maybe have a higher price point attached to it. Because the companies are still working through a lot of that excess inventory that's been pulled forward. But then as you sort of shift, let's say into the holiday season or even into early next year, that's sort of when you start to get into some of that inventory that now has a 15% tariff on it or some form of tariff applied to it.
So what are the companies going to do with that?
So it depends on the company and the industry. I mean, a lot of companies I think have obviously tried to not pass on as much to the consumer as possible. There may be some public or political blowback from that. Other ones maybe have a bit more of an elastic product, and so they do pass on some price. There's maybe a bit of a demand destruction element to it. And so I think a lot of companies are either trying to reconfigure their supply chains, trying to take internal actions to mitigate any of those impacts. Other companies are trying to, leverage their good relationships with suppliers to say, maybe we can share some of the burden of this tariff, where it's not just us, it's also you doing it. And so It really does depend on the company and the industry. But the key takeaway, though, is that we haven't really seen a lot of those tariff impacts hit the end consumer quite yet.
So there's more to come on that front.
Yep.
Steve, I might ask you just the breadth of research. We talk about it a lot. Some of it is in the form of going to do visits, trips, going to see these companies that are not just 5 that you need to tick off, but I mean, hundreds of companies, right? I mean, how many companies are you meeting? I asked Connor, I asked Christian, they're like 90, 48. I mean, how many companies are you meeting?
I mean, I've met thousands of companies,
Sure.
and I would say I meet hundreds of companies a year. But the team itself of 160 analysts globally, we're casting a very wide net. And the great thing is we have some of them dedicated specifically to covering U.S. small cap stocks, folks like Connor and Christian here. And part of what they do is really going out in the world and finding that information and bringing it back to us. Connor just mentioned Shark Ninja. Hugh and I were down at their headquarters about 2 weeks ago, meeting the CEO.
Where's this? This is
Outside of Boston.
outside of Boston.
Really interesting facility. They've got, I think, 64 different design labs. They're trying to make fans better. They're trying to make heaters better. They're trying to make blenders better. And all these categories that you think are super sleepy and super boring. And you look at the revenue in this company and it's growing double digits and it's taking market share from those less innovative, smaller companies that are not putting in the R&D and the effort. And so that was really fascinating to see firsthand and listen to the enthusiasm of the chief marketing officer and the chief development officer and the CEO. And then we get trips that we do all across the US and across the world where we'll send a team of industrial analysts to the Midwest, and they will spend 5 days on buses going from Milwaukee to Cleveland.
The bus tour, yeah.
Yeah, all these exciting places that they come back from and let us know what's going on. And then you realize it's better to be a tech analyst because you get to go to California.
That's where you just were, Christian, right?
Yeah, it is.
Are you on a bus tour?
Yep.
You were actually.
Yep.
Okay.
I can talk about that.
Yeah, tell us a little bit. I mean, I just
think,
thought it was interesting. You're traveling around to see these companies.
Well, I think that's a big part of what we do, right? Is kind of form a relationship with our companies and having like a deep knowledge of what they do. And so when you get markets like this, where you do have kind of exacerbated moves on one side or another of a debate, you can quickly determine whether you agree with that view or not, and act on it, right? That's the goal.
And pick up the phone to the right person, I guess. Yeah.
Exactly, or get the company online and get comfortable with your thesis or kind of where they sit. So yeah, I mean, as part of kind of our tech coverage, every June we go to the Silicon Valley. We meet with, I think this year was probably over 20 companies across kind of 3.5 full days.
Yeah.
And we get to see their headquarters, get to see their do. A lot of tech is pretty esoteric, and so it's nice to actually see the software or in many cases the hardware be built. We do that every year. I'm looking forward to it next year. This year we learned a lot. Steve was talking about the picks and shovels firsthand in his benchmark. We got to meet them, and things sounded just as good as the stock price would suggest. So it's obviously an important part of the process.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Connor, let's go through some of the consumer side of things, and ultimately, so there have been some winners and losers.
Yep.
They're different companies, though. They're often much more U.S. focused, which is why they're often covered under NAFTA, and it's okay for now. But maybe just talk about the evolution of some of these companies and where their markets are.
Sure. Yeah. I mean, it'll depend on the industry and what. I mean, I cover a lot of companies that obviously do have a very U.S.-centric business model. Their origins are in the U.S., but now they're starting to maybe branch out into other companies. So I cover restaurant chains that are still fast-growing in the U.S., but then they also have small but very fast-growing international businesses. Maybe the concept resonates really well in Europe or in the Middle East or in Australia or whatnot. And I maybe have other companies that are really just tried and true U.S. companies. We don't do anything else. It really just the products we serve or the customers we serve are really just U.S. focused. So it does depend on the industry.
How are the restaurants doing? Is there a broad statement, or again, is it a case of winners and losers? What's making a winner a winner right now?
I'd say it's been tough. And Steve mentioned earlier, kind of these bear markets kind of under the surface in certain subsectors. I'd say restaurants falls into that. It's been a bit of tough sledding this year for restaurants. And so I think what you've seen is that bifurcation between the low and high income consumer really shows up in restaurants. So you see a lot of chains where maybe you've taken a bit too much price the last few years. Maybe you haven't really kept up on innovation, or really struggling. You're not driving a lot of foot traffic into your restaurants. People just aren't going as frequently. They're maybe pulling back. And now those companies, you're seeing, McDonald's is talking about, reintroducing value items onto the menu, or, Chipotle or other ones like that. A lot of that, I think, is being done to spur a bit of more engagement and a bit more frequency with the consumer. Whereas there's other chains where, if you are positioned as, a value option or the lowest cost operator, you are seeing a bit of a benefit. You are seeing that trade down occur. And so, again, being the analyst and having resources to be able to focus on a lot of those companies allows us to not just maybe blanket the whole sector as, let's just stay away from this. Maybe there are certain, interesting opportunities on both sides, within that group. Yeah.
It's really interesting to hear sort of the restaurant, the embodiment of how the consumer's doing through restaurants. Picking up on the crumbs that we were talking about earlier, let's go through the data center build out to an extent, and Christian, you'll chime in here as well. But they're being built. This is happening. How much of the build out is going on? Is construction? What's it pulling on from some of the various names that you're covering? And maybe Steve will put this to both of you. Yeah.
Sure. So I think broadly, when you can think about a data center, probably about 1/3 of the spend is what we'll call the shell. So this is like the construction, the cooling, the infrastructure. Then 2/3 is the compute. So, the NVIDIAs of the world. So that's the first principles. And then as for kind of companies that we have under coverage, there's actually a lot that benefit from this. There's a lot of crumbs, so to speak.
Yeah.
So, you have the large caps like NVIDIA, but there's over $1 trillion of committed capital to this space, and it's not all going to NVIDIA. So I guess some examples of companies that I cover, there's a company called Element Solutions. They sell kind of chemical processes to make semiconductors. And so this is an important step in a lot of the fabs, like for TSMC. And so this was a company that kind of flew under the radar just because it was historically like a boring, call it like no growth, exposed to cyclical end markets, semiconductors, whatnot. And rising tide lift all boats. And this was a situation where AI actually ended up being really meaningful to their end markets. And so this kind of goes back to just having eyes on small companies and understanding where things are changing when the market might not, because the market tends to overshoot or undershoot on themes in the short term. And so just kind of first principles, having eyes on everything, understanding how things are changing, being able to act when you see those things changing is important.
Steve, some of this goes into obviously kind of the energy side of things, which may not be exactly where you're looking at, but then the components, as Christian was just mentioning, will pull on that. Give us a bit more of a sense of what's being put together to plug these things in.
Sure. I think if you look at companies like Lumentum, they make the lasers that go in the transceivers, that go in the semiconductors, and like kind of bring all these.
Sounds like a campfire song here.
Yeah,
really.
exactly. They bring it all together. You can look at the larger cap industrial companies that are involved in basically making the electricals of this huge box work because of the amount of electricity that's coming through these pipes. Areas that I find that are really fascinating right now, you have companies that are looking at future ways to make electricity, SMRs, so small modular reactors.
Right. This is the whole nuclear side of it, yeah.
Fuel cells, and some of the best performing stocks in the Russell 2000, which is the US small cap index, have actually been some of these energy companies. They've reached valuations that are many billions of dollars. Some of them are pre-revenue. All of them are pre-profits. And so one of the things that I'm thinking about is whether or not the market is putting too high a probability on success. So you need the data center spend to continue for a long period of time before it impacts demand and electricity. Right. And then you need to believe that they're technologies, whether it's SMRs, whether it's fuel cells, that they work, and you're already starting with very high valuation. And so whether it's that, whether it's quantum computing, I think there's different areas within the small cap universe where maybe we're getting a little bit ahead of ourselves. And so for me, I'm focusing on an area where I think that despite we're at all-time market highs, I think there is still some better values in the market.
So that's really interesting because it speaks to your style a little bit. I mean, a lot of anything to do with AI is going to sort of fit in the bucket of growth, isn't it? And unprofitable tech, and that's where it fits. Yeah, take us to your sort of style and approach a bit.
Yeah, I think growth investing is going out to a party on Saturday night and everyone's there with you and you're all having a great time because you're at the same party, you all believe the same thing, you're drinking the same Kool-Aid, everything's great. It's fun. It's fun to be a growth investor. Right. Value investors being at home with your parents on Saturday night. It's like being lonely. No one's called you in a long time.
But the money is stable.
Yeah, and so I look at these areas of the market that no one's joining the party from. Right. I think you've got I have a lot of my portfolio in financials right now. Areas like insurance, no one's gone to that party in a long time.
No, but those premiums.
Yeah, absolutely, and they're economically typically acyclical. Price to book values are very attractive. And so Connor actually used to cover a lot of these insurance companies and knows them quite well. I'm actually deeply underweight technology right now. I think that we've gotten a little bit too far ahead of ourselves on the valuations. If I think back 25 years ago when I was starting out similar to Christian here, the internet was going to change the world.
Yeah, and it did.
Yeah, it just took 10 or 20 years longer than people expected. And so I think these technologies are real. They are going to change. But I think my concern is that some investors may be taking on more risk than they actually are aware of. And so I'm focusing on some of these more traditional areas where there's high cash flow, high dividends, recurring businesses. And I think that the risk is that we could have a rotation in the market similar to what we experienced earlier in the year.
Yes.
Where some of these higher growth, more exciting areas of the market maybe pull back. And I think some of these more defensive cash flow businesses actually could have a strong rally. That's
really interesting as a bit of an outlook. Let's go to the consumer and the discussion again of actually where the holiday season takes us and sort of the idea it fits into that inventory discussion of when kind of the rubber meets the road on that. How does it look? Seems like back to school, for instance. I mean, it's not exactly what you're doing, but I don't know if people buy air fryers for back to school. But it seems like that went quite well, for instance. What about the next big marker?
Yeah, so it's we've seen various kind of companies and agencies and industry groups kind of put out outlooks maybe around a bit more of a cautious holiday season. You think about certain factors impacting the consumer right now. You think about like student loan repayments starting back up again. Interest rates we've gotten a cut from the Fed, but interest rates haven't really provided a ton of relief. And at the same time, we've been hearing from companies that, retailers are being a bit cautious around their holiday orders that they're putting in terms of stocking it. Usually that prime holiday shopping period is US Thanksgiving all the way up to Christmas. And it seems like, based on when we talk to companies that sell into retailers and the retailers themselves, that window is getting a bit more compressed and that the holiday shopping is happening a bit later than usual. Retailers are stocking a bit more cautiously. And so it's going to be interesting to see how it plays out. Obviously, we're going to have a much better idea of how it all kind of develops over the next couple months. But it does seem like there was a bit more caution being thrown to the wind a little bit around holiday season, despite the fact that, back to school was generally pretty robust.
So there is a bit of a wait and see on basically the tariff situation. I mean, you just have to see how those prices, first of all, go in, and second of all, what the uptake is.
Yeah, and again, I mean, it's different in different industries, but at least with the companies that we talk to pretty regularly, you haven't really seen that full flow through happen quite yet to the end consumer. Like it's still, the burden is still being shared kind of across, suppliers, company that sells to a retailer, then the retailers themselves, but it hasn't quite made it to the very end of that chain yet to the end consumer.
So we have to check back in with you sort of in January to see where some of those numbers have gone. Let's go a bit to the software companies themselves, which you mentioned. Things get overdone. There's a debate that you mentioned earlier is still there. What are the software companies doing with the fact that AI is upon us? They are adopting it. They are helping use it in their own sales. How is it being deployed?
Good question. So this is where it's super valuable to actually go and meet them, because you can, you get one debate in the market and then you see them, and it turns out AI has actually changed the way they work. Developers are more efficient than they've ever been because you can use AI to help you code. It doesn't replace a developer necessarily, but it really increases time to value. And that's super valuable for the R&D flywheel that I was talking about earlier, where they're close to customers, they put out new products, they earn the right to be a bigger part of the budget. That flywheel actually gets quicker because of AI. You also have, agents to support sales reps, make sales reps more efficient. Software companies move fast. They're innovative, they're on the leading edge, and so they were among the first to develop or adopt AI. When I went to some conferences back at the end of 2024, my software companies are already telling me that they were like hand over fist using AI. And that narrative kind of didn't start to evolve until later in 2025. So they are fast moving.
They're not going to get leapfrogged here.
No, and if anything, time to value, you can argue, is accelerating for them across the industry just because coding is getting more efficient.
That's really interesting. So in terms of the benefits to companies, Steve, I mean, this has been a question for, I don't know, however long, whenever ChatGPT broke through that November back in 2022, I think it was. When ultimately is AI accretive to the companies that you're putting in funds that you want to? They're all moving faster. The productivity is there. It's on the SG&A.
So far, I think most companies are in trial mode.
Yeah, they're still there.
They're looking to see where they can use it. I think call centers has been an easy and early win. Number of heads in a call center has gone down. One of the very simple examples is typically if you call in and you want to have an issue, I don't know, with your insurance, at the end, the call center agent types up some notes about what you talked about. So if you call back again, they have notes. Now an agent, an AI agent is going to type up those notes and have that summary, and allows them to go on to the next call. And so it's a very simple example. And I think in some of these lower end jobs, you're starting to see some of those benefits. But more broadly, I don't think you're typically seeing it at any bank saying we're taking our costs down by 5% because of this technology. And so it's one of the areas that is still overhanging broader AI of what are the use cases, what's the ROI. I think the companies that I can think of have made the most use of it would actually be some of the hyperscalers. Meta being a great example of monetizing traffic, knowing, you like cat videos, but it's not just cats that you like, you like tabby cats. And they serve you all the tabby cat videos they can, and then they figure out that, you like Meow Mix. And next thing you know, you're buying some Meow Mix, and the algorithm.
Is the cat involved in this decision at all? Or
probably.
Okay.
Probably. And so they're doing a good job of making sure that the content's more relevant, the advertising is more relevant. They've seen a growth acceleration in their revenue for that. From a cost perspective, it's been more challenging, and I think for AI,
so it's almost additive in a sense, rather than cutting costs.
Yeah, and so I think a lot of CEOs feel the need to be able to go to their board and say we are working on AI. We haven't necessarily found those killer apps just yet.
Fantastic. Okay, Connor and Christian, I'll ask you to do sort of a final thought on the industry and the part of the market that you're following, just to leave with investors. Connor, we'll begin with you. What's a final thought?
I think just for investors, I think just emphasizing, I guess, the resources that we have dedicated to consumer, and same with Christian as well, dedicated to software and technology, where these are maybe lesser known parts of the market, or parts of the market that maybe don't grab the headlines the same way that AI or big hyperscalers or Mag 7 would command. But there are real companies in these markets. They're all going through their own different cycles right now, and it's our job to sort of meet all these companies, find those interesting opportunities, and that's what we do every day. We get to show up and
sounds like a fun job.
It is, yeah. It's quite exciting. So,
Christian, what would you leave with investors?
Yeah, I would just say things in tech are changing really fast. The market is aggressively grouping businesses in sort of the right or left tail of outcomes here. And there are more rocks to turn than maybe there ever have been. And so rest assured that we're doing it, and it's a really fun time to be looking at software.
Fantastic. Steve, Christian, and Connor, thank you for joining us here on Fidelity Connects. Look forward to seeing you again.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.